Welcome back, and we're joined by Suyog Kotecha, CEO and Executive Director at Aarti Industries, joining us this morning. Great having you here, Suyog. Let me first start off with
Good morning.
how raw material prices are trending for you, how much of it has been passed through, because the numbers seem to suggest that it's a very, very strong set. So trying to get a sense as to what's played out.
Yeah. No, I think the global macros continue to remain extremely volatile. I think the raw material pricing scenario remains elevated, significantly more elevated compared to where we were before the West Asia conflict started. That's not changing. And that has had a mixed impact. I think on volume front, we actually saw quarter-on-quarter dip. But I think the ability and the strength of the diversified portfolio and very strong customer relationship ensured that we were able to pass on a decent part of that raw material increase to customers. And the combination of price pass through, cost optimization, and product mix optimization is what led to the performance that you see in the last quarter. It was also supported by some amount of FX and inventory gains. But nonetheless, I think in this highly volatile scenario, the ability to manage supply chains played quite critical role. Going forward, we are actually seeing volume recovery. So I think in this quarter and going forward, we are seeing volumes coming back in most of the end segments, barring one or two where people are sort of either delaying their purchases or optimizing their production linked to extremely high price environment. But we expect overall volume recovery also to come back from this quarter onwards.
Interesting. So you wouldn't have to pass on anything to the consumers and no impact on margins. All of that you're saying is behind us?
Well, I think, look, in the current situation, I think it's very dynamic, right? I think we have a very wide variety of products in our portfolio, and different end markets play very differently. For example, energy as a segment, we saw a good demand, but volumes dropped because one of the regions we could not serve, especially in Middle East, which used to be 15% of our revenue, came below 2% of our revenue in this quarter. But we were able to divert that product to other regions because demand was very strong. So that market plays very differently compared to something like agro or polymer, where people tend to optimize their purchases if they anticipate prices to correct. And that's where you see volume drop coming in, people waiting out to see how the price trend pans out. At some point in time, they start filling their supply chain and inventory, right? So that's the volume that we see coming back in this quarter. So different end markets will behave differently. I don't think there is sort of one story fits all kind of a strategy. Our job is to remain very agile and sort of work with our customers to ensure that both volumes and margins we are able to maintain as much as possible.
And just give us a sense, your margins are at now a multi-quarter high, right? Can you sustain at this level? Can it get better? Could you give us some color on how this environment is evolving and how you're adapting to ensure that margins stay ahead of the curve?
So in this quarter, there was a bit of a support in the margins linked to FX and inventory gain. So they will normalize going forward. But as I said, we've kept saying we track absolute EBITDA in rupees crores. And in that context, given the volume recovery, compared to the first quarter, on absolute basis, we should be able to maintain. There is, of course, some correction expected linked to FX and inventory gain that we saw in quarter one. But broadly, I think, operating in the range of sort of 14-15% odd EBITDA margin is sort of our medium-term target.
Also, what I wanted to understand was, the fact that last quarter you had said that, China's anti-involution measures would start benefiting your PNCB and NCP businesses as well. Tell me where things are as of now and whether or not there are any early signs of better pricing already visible.
That's actually panned out. I think the way we had talked about it last quarter in the NCB chain, we have seen margin uptick, and that's one of the contributor of this quarter's performance. But given the China's export rebate removal, we saw significant uptick in terms of pricing and margin in this quarter from NCB chain. That continues. It's getting sort of moderated and it's getting adjusted to its new normal going forward. But compared to historical levels, it will definitely settle at better margins compared to, let's say, what we saw in the last financial year.
And West Asia's contributions, of course, have fallen. uh, do they start to reboot? Do you start to see light at the end of the tunnel? If so, when? How do supply chains start to normalize? Give us a sense.
So we are figuring out creative ways to serve that market, and I think there are some early signs that we might be able to get some volumes back, and that will remain our sort of consistent effort. At the same time, we have ensured that we have taken enough efforts to develop other international market where the overall impact is mitigated significantly. So if the West Asia comes back, then we could have even better volume recovery going forward. But at this point in time, the effort remains twofold. One, that we continue to develop other international market to minimize the impact of one particular region. At the same time, figure out a creative way of serving West Asia market to get back share that used to go there a few quarters back.
Okay. And with regard to sourcing, is there any concern with regard to sourcing of raw materials given the current environment? How is China behaving at this point of time, and how is raw material price itself evolving? Will it likely cool off, and how quickly can it cool off if things were to resolve itself?
So I think I'll answer that in two parts, right? One is the raw material volume availability and our ability to source it. There was an impact in the last quarter for a while where we did not have enough raw material and we had enough demand for some products. But I think we have corrected our strategy on that front. For domestic purchase of raw material, we have long-term contracts. We have very deep relationship with our suppliers, and that remains available to us. Of course, pricing you have to pay linked to international market, but I think availability is relatively secure. Our long-term contracts on nitric acid, our long-term relationship for the supply of benzene and sulfur is coming in handy at this point in time. For imported raw material, which is typically aniline and methanol are the two largest imported raw material, there we saw impact due to supply chain issues in the last quarter. But there, sort of, we have course corrected. We have got into some medium-term contracts with some of the large manufacturers to ensure that our supply chains are kind of secured. And that's what gives us confidence that we should be able to push for volume recovery in the coming quarter. On the pricing front, frankly, anyone's guess at this point in time. The kind of volatility that we have seen in West Asia and the linked raw material pricing volatility is unprecedented. So the only thing we can do at this point in time is to remain very agile and to ensure that we manage our product mix and a portfolio in a way where we minimize the inventory exposure, right? And that's what we remain focused on.
Okay. All right. Suyog, thank you so much for joining us.